Picture this. You've just agreed to a term sheet for a massive loan.
Right.
And this isn't just any standard business loan. You're backing it with your very own, very impressive multi-million euro investment portfolio.
Oh, nice.
Yeah. You've gone through the grueling back and forth negotiations. You signed all the papers. The ink is completely dry, and you are ready to deploy that capital into your next big venture.
As you should be.
Exactly. But when you log in to check your account, it's empty. So you call the bank, fully expecting like an apology for a minor glitch, and instead they simply say, not yet.
Which, if you are the client sitting on the other end of that phone call, is just nothing short of infuriating.
Right.
I mean, you feel like you've held up your end of the bargain, you made the deal, you expect the funds to flow.
And that is exactly the tension we are exploring today on this deep dive, because it feels completely intuitive that a signed commercial agreement should automatically trigger the release of those funds.
Yeah, it feels like it should.
But in the world of high finance, a signature on a term sheet is, well, it's really just the starting gun.
Just the beginning, yeah.
Today, our mission is to unpack the rigorous kind of hidden mechanics of Luxembourg Lombard facilities, drawdown controls, and the financial collateral framework.
We want to show you exactly why that money is held up at the gate.
Right. And to do that, we're basing our entire conversation on a stack of official, legal, and regulatory texts. Specifically, the foundational Luxembourg law of 5 August 2005 on financial collateral arrangements.
It's a classic.
And along with the latest circulars from the CSSF, which is Luxembourg's financial regulator.
It is a phenomenal ecosystem to study, actually. I mean, we're looking at the clash between a client's entirely understandable expectation for immediate liquidity.
Give me my money.
Exactly. That versus the strict, multi-layered legal gates that a lender is legally obligated to close before a single euro is allowed to leave their vault. Yeah. Because to the client, those gates feel like bureaucratic red tape, But to the bank, they're the absolute bedrock of institutional risk management.
Well, before we can understand why your money is stuck, we need to establish the baseline. Like, what kind of financial structure are we actually dealing with here?
Good question.
We use the term Lombard facility, right?
Yeah.
So how does that differ from, say, a standard corporate loan or a mortgage?
So a Lombard facility is a specific type of credit line, and it's secured strictly by financial collateral.
Okay.
Think about a mortgage, right? You buy a house, and the bank holds a lien on that physical property.
Right, they can take it.
Exactly. If you don't pay, they take the house. A Lombard loan uses the same underlying logic, but instead of physical real estate, you are putting up liquid financial assets.
So if I have a massive portfolio of, blue chip stocks, government bonds, or even just cash sitting in various accounts, I can leverage that existing wealth to get a loan.
Precise.
Without actually having to sell off my investments and, trigger capital gains taxes.
Yeah, that's precisely the appeal. If you default, the bank liquidates that portfolio to recover their cash.
Makes sense.
But because we are dealing with financial instruments rather than, say, a physical house on a plot of land, the mechanics of how the bank actually secures those assets are entirely different.
And that brings us to the core actors in the room, right?
Right. There are three main players. You have the borrower, who acts as the collateral provider. You have the lending credit institution, the bank writing the check.
Okay.
And crucially, you have the custodian or the account bank.
Now, I want to pause on that third player because this is where the dynamic gets super interesting.
Yeah, it does.
If you are listening to this and you've ever taken out a loan, you usually deal with one entity, right? The bank.
Just the one, yeah.
So if I want the loan and the lending bank wants to give me the loan, why is there a third party crashing the transaction?
Well,
like, why does a separate custodian essentially hold the power to stop the entire deal?
Because it is entirely by design. The lender is only willing to give you millions of euros based on the absolute ironclad certainty that your assets are locked up and available to them if things go sideways.
Okay.
But a lending institution generally does not hold those assets themselves in the exact same capacity they lend from.
Oh, interesting.
Yeah. They require an independent or at least highly segregated custodian to act as the neutral party holding the bag.
Ah, got it.
The custodian's job is to secure the perimeter. If the custodian has not formally confirmed that the assets are legally locked down, the lender has zero security. And no security means no loan.
That separation of powers makes a lot of sense. It basically prevents the lender from acting on blind trust.
Exactly.
And I know our sources highlight specific regulations governing who these lenders are, like CSSF Circular 22824 is a major one.
Very important, yeah.
But my understanding is that it doesn't apply equally to every single bank in Europe.
Right. That is an essential nuance, actually. The CSSF sets the standard in Luxembourg, and their Circular 22824 specifically applies to what the framework calls less significant credit institutions,
Okay.
as well as Luxembourg branches of third country institutions and certain professionals performing lending operations.
So wait, what happens if you are dealing with a massive multinational significant institution? Do they just get to ignore these rules?
No, far from it. Significant institutions are directly supervised by the European Central Bank, the ECB, for their main operations.
Oh, right.
So they follow ECB rules for the heavy lifting. However, the CSSF circular still pulls them into scope when it comes to specific consumer protection provisions.
Okay, so they can't escape it entirely.
No. The overarching goal, whether you answer to the CSSF or the ECB, is sound credit quality.
Okay, so we have our three actors, right? The borrower, the lender, and the custodian guarding the assets.
Right.
But if the custodian is like the bouncer standing at the door,
Yeah.
what are the actual rules of the club? How do they legally lock down a digital portfolio?
Well, that brings us to the absolute bedrock of this entire system, which is the Luxembourg Law of 5 August 2005 on financial collateral arrangements.
The big one.
The big one. This is the text that everything else in Luxembourg high finance basically orbits around.
Let's define some terms from that law because, financial documents love to throw around heavy jargon.
They really do.
The law mentions financial collateral arrangements and lists things like pledge agreements, title transfer arrangements, and repurchase agreements.
Yeah.
If I am the client, I just want my loan. So what do these terms actually mean in practice?
Let's translate them. A pledge agreement is the most intuitive. You still own the assets, but you grant the bank a legal claim to take them if you default.
Simple enough.
Right. A title transfer arrangement, on the other hand, means you are actually transferring legal ownership of the assets to the lender over the duration of the loan.
Wait, really? So the bank actually becomes the legal owner of my stocks while the loan is active?
Temporarily, yes, but with a contractual obligation to return equivalent assets once you pay the loan back.
Wow.
And then you have repurchase agreements, commonly known as repos.
I've heard of those.
Yeah. This is where you technically sell the assets to the bank for cash today, with a legally binding promise to buy them back at a slightly higher price on a specific date in the future.
Ah, so the price difference is effectively the interest on the loan.
Exactly. The 2005 law basically acts as a massive umbrella that legally protects all of these different mechanisms under one unified framework.
That unified framework is so crucial. But the part of the 2005 law that really stands out in our sources is Article 5.
Yes. Very important article.
Because it deals specifically with how a bank proves they have possession of book entry financial instruments.
Right.
And by book entry, we mean digital records on a screen, not
right.
Paper stock certificates locked in a wooden chest somewhere.
Yeah, we're way past paper.
Securing a physical gold bar is easy. You put it in a safe.
Hmm.
But how does a bank legally prove they are holding a digital asset?
Article 5 solves this digital dilemma by outlining 4 very specific methods to establish legal possession.
Okay.
The first method is straightforward. The pledgee, the lender, also acts as the custodian. They hold the accounts in-house, so they simply lock their own ledgers.
But earlier we talked about the separation of powers. What if my assets are sitting with a totally different broker or an independent custodian?
Right.
How does the lending bank legally reach over and lock those down? Do they just send a polite email asking the custodian to freeze the account?
No, a polite email wouldn't hold up in court. That scenario requires method 2, which is a tripartite or notified arrangement.
Tripartite meaning 3 parties.
Exactly. The borrower, the lender, and the third-party custodian all sign a legally binding agreement.
Okay.
And the custodian formally agrees that from this moment on, they will only follow the lender's instructions regarding those specific assets, basically ignoring any requests from the actual owner until the loan is settled.
Man, that is a serious transfer of power.
It is.
So what are the other 2 methods?
Method 3 is direct registration, where the digital financial instruments are actually transferred and registered directly into an account held in the lender's name.
Okay.
And method 4 is designation, where the collateral isn't moved, but it is formally designated and tagged within the custodian's internal ledgers as being pledged to the lender.
When you lay it out like that, those 4 methods are actually more secure than a physical padlock.
Oh, without a doubt.
Because If a bank uses a tripartite agreement, they are establishing an unbreakable chain of command. In modern finance, the custodian's digital ledger is the ultimate source of truth, right?
Exactly.
So if that ledger is legally rewired to only obey the lender, that digital asset is secured far more tightly than a physical gold bar that could just be stolen. The legal framework literally becomes the vault.
The legal framework is the vault. I think that is the perfect way to visualize it. And, Luxembourg's implementation of this concept is considered one of the most creditor-friendly and robust in the world.
So, okay, we have built an impenetrable legal vault. We have established possession under the law of 2005.
Yes.
But let's go back to our frustrated listener who signed the term sheet and is staring at an empty bank account. If the legal vault is locked, why is the money still not released?
Because locking the vault is only the first step. Next, the client has to pass through the drawdown gates.
Drawdown gates?
Yeah, a drawdown condition is a contractual and operational checkpoint that absolutely must be cleared before a single cent is transferred.
And looking at our sources, this is a heavy checklist.
It is a very heavy.
We are talking about final credit approval, fully signed facility and pledge documentation, the account control mechanics we just discussed, valuation and haircut checks,
yes,
and finally strict anti-money laundering or AML and counter-terrorist financing controls.
Yep. The regulatory driving force behind all these gates comes from the European Banking Authority, the EBA.
Okay.
Their guidelines on loan origination and monitoring became effective in 2021, and Luxembourg applied them locally via that CSSF Circular 22824 we mentioned. Right. And the fundamental objective here isn't to create administrative bloat or annoy clients. The objective is to ensure banks maintain incredibly prudent approaches to credit risk management.
Well, let's dig into a couple of these gates because they can be a bit confusing. You mentioned valuation and haircut checks.
Yeah.
What exactly is a haircut in this context? I'm assuming the bank isn't sending a barber to the client's house.
No barbers involved. A haircut is essentially a safety buffer for the bank. Financial markets are volatile, right?
Sure.
So if you pledge 10 million euros worth of tech stocks as collateral, the bank knows those stocks could drop in value by tomorrow.
Okay.
So they apply a haircut. They might decide the stock has a 30% haircut, meaning they will only value that portfolio at 7 million euros for the purpose of the loan.
I see.
They lend you against the post-haircut value to ensure they are over-collateralized if the market crashes.
That makes total sense from a risk perspective. But I want to play devil's advocate on the compliance side.
Okay, go for it.
Let's say I am the client. I went through the bank's extensive onboarding process 2 months ago. I provided my passport, my corporate structures, everything.
Right.
They approved my facility limit. Why do they need to rerun AML and KYC checks right at the exact moment I request the drawdown? Doesn't the initial approval cover this?
It might seem redundant, but time is the enemy of certainty in risk management.
How so?
A client's legal and financial status can literally change overnight. A corporate director who was perfectly clean during onboarding 2 months ago might have been added to an international sanctions list this morning.
Oh, wow. I didn't think of that. So if the bank relies on 2-month-old data, they could accidentally wire millions of euros to a newly sanctioned entity.
Exactly. And the regulatory penalties for doing that are astronomical.
I bet.
AML and KYC are not just onboarding trends. Our sources explicitly state they are permanent structural pillars of the transaction.
Wow.
The gates must be checked at the exact millisecond of execution because the bank has to manage the risk of today, not the risk of last month.
Which really brings us to the sheer operational reality of making this happen.
Right.
Because understanding the theory of these individual gates is one thing, but making them all open simultaneously without breaking the transaction, that's the true challenge.
It's massive.
The sources refer to the concept of a clean file.
Yes. The clean file is the holy grail of drawdown operations. For a transaction to proceed, the credit file, the securities account, the pledge agreement, the valuation, and the release instruction must all tell the exact same story at the exact same time.
And the sources outline 3 specific pre-drawdown evidence requirements that have to perfectly align to achieve this clean file. What are they?
First, the obligations must be validly constituted under the facility agreement.
Meaning the loan contract is rock solid.
Exactly. Second, the pledge must strictly and explicitly secure those specific obligations. There can be no ambiguity about what assets are backing what debt.
Got it.
And third, the pledged assets must be under the documented control of the collateral taker, the lender using one of those Article 5 methods we discussed earlier.
I kind of picture this entire operational process like a multi-lock bank vault in a heist movie.
That's a good analogy.
like the legal team, the credit team, the compliance team, and the custody team, all have to insert their respective keys and turn them at the exact same second for the money to be released.
Yes, exactly.
So walk me through what happens when just one data point falls out of alignment. Let's say there is a sudden market dip that alters the valuation haircut right before the release instruction is given. What happens to the vault?
The vault goes into immediate lockdown.
Really?
Yeah. If the market dips, the collateral valuation drops. Suddenly, the amount of money you were trying to draw down exceeds the agreed-upon margin limits, even with the haircut factored in.
Okay.
The clean file is no longer clean. The credit team's key simply will not turn.
So the whole process just halts. The client doesn't get like a partial payment.
Everything halts. The release instruction is suspended.
Yep.
The client now has two choices. They either have to formally request a smaller drawdown amount that fits the new valuation, or they have to post additional collateral, more stocks, more cash, to make up for the market dip.
Basically topping it off.
Exactly. The system is designed to fail safe. It will not let the money leave the bank if the math does not perfectly align with the legal agreements at the exact moment of execution.
And there is a real-world cost to all of this coordination, isn't there?
Absolutely. The operational context involves significant overhead. Costs depend heavily on the institution's pricing framework, the complexity of the collateral, and whether external legal counsel had to be brought in to review, complex corporate structures.
Right.
And interestingly, while taxes are always a consideration, our sources note that tax impacts are usually secondary at the drawdown stage, unless the structure involves cross-border collateral or complex fund interests.
Which is particularly relevant in the Luxembourg context, right? Because Luxembourg is known as a global hub for private banking and wealth management. So how does that ecosystem impact these operations?
Well, Luxembourg is unique because custody, investment services, banking, credit, and wealth structuring often merge into one single relationship model for the client.
Okay, so it's all under one roof.
Yeah. The client gets a sleek, unified interface. But behind the scenes, Chinese walls still exist. The internal teams still have to execute these complex alignments flawlessly.
That is incredibly strict, which makes our next topic even more intense, I think.
Oh, definitely.
Because perfect alignment takes a lot of time and human coordination. But the overarching market clock is about to speed up dramatically.
You need to look at the horizon. Because if you check the current market pulse, the sources confirm there are no sudden, massive structural regulatory shifts happening tomorrow.
Right.
Right now, the industry is entirely focused on pure execution of the existing rules. But there is a confirmed milestone approaching on October 11th, 2027.
Okay, mark your calendars. What happens in October 2027?
Under the Central Securities Depositories Regulation, or CSDR, the European market will legally migrate from T+2 to T+1 settlement.
Let's break that down for anyone not living in the trading weeds. T+2 means that when you execute a securities trade, it takes 2 full business days for the transaction to officially settle and the ownership to change hands.
Correct.
T+1 means it settles in 1 business day.
Okay.
It happens essentially overnight.
Exactly. And the CSSF has explicitly stated that starting October 11, 2027, the CSDR introduces the strict obligation to migrate to this faster cycle.
This shift is going to massively compress the timelines for security settlement and collateral operations across the entire post-trading chain.
Yes.
But let me ask you this. It's just shaving off 1 single business day. If you were running an institutional Lombard facility, does losing 24 hours really put that much strain on your operational chain?
No, it fundamentally rewires the reality of the timeline.
Really?
Think about the multi-lock vault we've been discussing. Right now, if a trade settles on T+2, the operations teams have a 48-hour buffer to resolve a valuation dispute, or fix a mismatched pledge document, or run a secondary manual AML check if a red flag pops up on a corporate director.
Okay.
When you move to T+1, you lose that entire buffer.
So if a client needs to move collateral from a third-party broker to satisfy a drawdown condition, they have to do it instantly.
Yes, that settlement must happen overnight. If the file isn't perfectly clean by the next morning, the trade fails. The drawdown fails.
Wow.
Losing 24 hours in institutional finance is like taking half the oxygen out of the room. Everyone has to work twice as fast with zero margin for error just to breathe.
That paints a very intense picture of the future. The operational teams are going to have to be absolutely flawless.
They will.
Well, we have covered a massive amount of complex ground today. Let's try to synthesize all of this into the core must-knows for you, the listener.
I'd say the first major takeaway is managing expectations. Drawdown is never triggered by a commercial agreement alone.
Right.
It strictly follows final credit approval, completed documentation, and verified operational conditions. A signed term sheet is just the starting line, not the finish line.
Okay, second takeaway. In a Luxembourg Lombard facility, collateral control is the absolute beating heart of the system. The pledged assets must be clearly identifiable and effectively brought under the bank's control using the strict methods of the 2005 Financial Collateral Framework.
Exactly. And the third takeaway, the clean file is the only file that matters.
The Holy Grail.
Right. Your facility agreement, the pledge, the account control, the valuation haircut, the AML checks, and the release mechanics, they must match perfectly. If any single data point is out of alignment, the client simply does not get funded.
Ultimately, the objective reality is that Luxembourg's strategic relevance in global finance stems directly from its highly creditor-efficient financial collateral law.
Absolutely.
But the brilliance of that law is entirely dependent on the human beings in the front office, credit, legal, compliance, and custody teams executing in the exact right order. The law provides the blueprints, but the operations teams have to build the house flawlessly every single time.
It is a delicate balance between legal theory and operational execution.
Before we wrap up, I want to leave you, the listener, with a final thought to mull over. We talked about the intense pressure coming in October 2027 with a move to T+1 settlement.
Yeah, that fast clock.
Right. It's forcing these complex, multi-party alignments to happen twice as fast, effectively overnight. So, as the regulatory clock continues to speed up, will the strict, currently manual legal mechanisms of possession eventually need to be entirely automated by smart contracts and blockchain ledgers just to keep up?
That's a great question.
Will the human element of turning those multi-vault keys eventually be replaced by self-executing code?
I mean, if the margin for error drops to zero, automation might be the only way the vault can continue to function.
It is definitely something to watch as we get closer to 2027. Thank you for joining us on this deep dive into the hidden mechanics of high finance and Lombard facilities. We'll catch you next time as we continue to explore the intricate systems that make the world tick.